It's the start of a new year, 2019. Happy New Year to everybody. And we're going to talk about the best investment tips for this new year with our panelists. Norman Villamin, he's the CIO of UBP. Thomas Heller, the CIO of Schwyzer Kantonalbank. And Lars KALBREIer, the CIO of ROUNDTABLE Wealth Management. Welcome, gentlemen, to this round of our panel. Let me ask, first of all three of you, which is the top investment advice that you have, Norman, for this year?
Well, I think for us, it's to be opportunistic. As we saw in 2018, we see a lot of volatility coming into markets. That creates opportunities where markets sell off too much. And investors need to capitalize on when markets give those opportunities to you.
What is your top tip, Thomas?
I think it will be a challenging year for the markets once again, not as bad as 2017, but a challenging year. If I had to pick one asset class, I'd probably go with emerging market bonds.
And your top advice, Lars, do you agree with that?
On the emerging market side, yes, definitely. I think the top advice is that there's more risk not to be invested than being invested in the long run. In fact, it's very tempting right now to have a large cash position because of what's been happening in 2018. Having said that, over the long term, cash always underperforms a diversified portfolio.
If I may stay with you, Lars, the key themes for the new year are the US-China trade war, the slowing global economic growth, as well as the US Fed's monetary policy. What does your portfolio construction look like at this beginning of 2019?
Well, we are neutral on equities. Having said that, we are long, so overweight emerging market equities. We are long Japan. We are neutral US equities, and we are underweight European equities. On the three issues you've mentioned, we believe that the Fed is almost done increasing interest rates. Therefore, that headwind will recede somewhat. We believe that there will be an agreement on trade between China and the US because it's been hurting both countries. And we also believe that much of the slowdown in the world economy has now already been priced in.
Earnings growth has been slowing, Eurozone growth as well, the tensions that we have just mentioned on the geopolitical side as well. In this environment, Thomas, where do you see the most attractive, if we can say that, valuations?
It's really hard to be on a relative basis to find out where the most value is. We will enter the year, or are entering the year relatively defensively. And then it much depends on how the trade war or the trade conflict will be resolved, whether it will be resolved or not. If it will be resolved, at the end of the day, I think it will. Things will turn better. Then we can start moving to cyclical sectors more and remove our positioning in the more defensive sectors.
So, Norman, would you as an investor take a more dovish position, less risk appetite, or do you still see some opportunities and risk appetite out there?
It really is about managing risk, we think, in 2019, and we're doing that via hedge funds, which is a big part of our portfolio, but also using options and capital-protected strategies in the portfolio. But that said, there are opportunities that we think investors can exploit. I think one area that we think is quite interesting are the industrial commodities in 2019. There are very good supply-demand imbalances in place, and the weakness in 2018 has really created good valuations for a lot of these names.
You mentioned the risk hedging strategies. Lars, at ROUNDTABLE, what kind of risk hedging strategies are you putting into place?
Well, what we usually have in our portfolios is deep out-of-the-money puts. And that is something which is similar to an insurance policy on a house. Usually you never need it against, let's say, fire, but there might be a time where you need it. And that's why we tend to mix that into the portfolio.
And also to reassure your clients, right? Are they more risk-averse at this point in time, do you think?
There's always a correlation between what's been happening in the markets and risk aversity. But that usually is also an opportunity. In fact, you want to buy when investors are frightened And in fact, you should rather sell when investors are extremely optimistic.
One moment we remember in 2018 was the plunge of the tech stocks. Do you expect a fresh weakness of tech stocks, Thomas, in 2019?
No, I don't think they will weaken further. There's some potential even because valuations are, let's say, okay. Depends on market reacts more quickly than analysts do. So if earnings will be revised, the earning estimates, they still are not too cheap, but the valuations are not an issue. So I think there's some value in tech stocks as well. I don't think they will plunge further.
If we zoom out, Norman, do you still favor US stocks, US equities versus Eurozone stocks, or what's your position there right now?
Well, versus the Eurozone, yes. I think it says less about the US and more about Europe. We think the headwinds in Europe are quite meaningful, really across the board, whether you're talking about earnings, economy, political. And so we would prefer the US to that. But when we look at the US standalone, we don't see enormous value. We think earnings expectations are a little bit too high and probably need to come down in the beginning part of the year, and that'll be a headwind for the market as a whole.
And you, Lars, which sectors or companies are you underweight and overweight in the Eurozone especially?
Well, we think that defensive sectors have already appreciated a lot, and therefore, going into the year, we would have a preference for cyclical sectors. The key reason for that, and especially in the mid-cap space, for instance, key reason for that is that cyclical sectors have substantially underperformed over the last year, and therefore are more attractive in terms of valuations.
Is this also valid for the Swiss market? Are you also bullish on Swiss mid-sized companies here?
Yes, in fact, if you look at the SMI versus the SPI, so the SMI being the large cap Swiss index versus the SPI, which has also some mid-cap companies in it, you will see that the SMI over last year has substantially outperformed the SPI. The SMI is more defensive in nature, and we've seen lots of investors investing in large cap defensive companies such as healthcare or consumer staples, for instance. We believe that now getting into the new year, that might very well change. In fact, the cyclical sectors, which have substantially underperformed, are likely to benefit if we get a trade resolution between the US and China, and therefore have much more potential to appreciate.
What is your performance outlook for the SMI, Thomas, in 2019? Will it fare much better than the past year?
Yeah, I hope so, at least. No, I'm pretty confident it will do better than 2017.
What are some of the driving factors? What makes you feel so optimistic about it?
Because I don't think we're going into any kind of recession. A Fed hiking cycle is coming to an end. Hopefully we'll find a resolution for the trade conflict, China and US. Do not forget the resolution between the Eurozone and the US. And if that turns out well, I'm pretty optimistic that the markets will perform positively next year, but in a low single-digit number.
We saw more red days than green days on the SMI in 2018, but where will it end 2019, do you think, if you take a crystal ball, Norman?
I think the key is going to be earnings growth. And we don't think multiples are going to expand very meaningfully from here. And so earnings growth is going to be very important. And that, for Switzerland, luckily, is driven by global growth. And so from that perspective, we think kind of mid-single digit is a reasonable expectation for investors in Switzerland in 2019.
Now, alternative investments are booming. Sustainable finance, impact investment. What is your view on this booming industry, Norman? Is it not too much?
I mean, the alternative investment universe has been out of favor for a number of years. And we think the market dynamics are really playing to its strength. Really leaning on non-directional types of activity, focusing on stock selection and manager skill at identifying opportunities and risks. And so we think it's an important part of portfolios now for 2019.
So alternatives, Lars, are seeing a revival. How bullish are you on hedge funds and their comeback?
Well, first of all, hedge funds had a very, very tough time in recent years. And there are two reasons for that. Mainly, we had central banks which were distorting the investment universe by having a monetary policy which was extremely loose. It was an artificial monetary policy. And that means that stock picking was also very difficult, and long-short strategies did suffer from that. If you see what is happening right now, we see that some central banks have started to normalize their monetary policy. The biggest one in the world, the Fed, has already done it to a certain extent. And that is an environment which is better for stock pickers, therefore also better for alternatives. We always have alternatives in our portfolio. It's a good diversifier. It's an asset class which is slightly less correlated with other asset classes. Therefore, in a diversified portfolio, they have their raison d'être.
Would you agree with that point of view, Thomas? And what type of alternatives would you be most interested in?
Yes, first of all, I fully agree. Alternatives should play an important role in a portfolio. Maybe I'm not too much into hedge funds. We have a small portion in hedge funds as well.
What other alternatives are you looking at?
Things like private equity, loans, insurance-linked securities. These are the kind of alternatives we're looking at and hold them in our portfolios. I think they're a good diversifier and really need to be a big part of a balanced portfolio.
This is quite risky, though, putting a lot of money into alternatives. How would you hedge your strategies there, Norman?
It's risky from, I will call it, from a liquidity perspective. So it's not as liquid as being in stocks or in bonds. And so I think it is about sizing the positions and then realizing why you're in and whether you're being paid for that illiquidity in portfolios.
So what percentage of your portfolio would you actually allocate to alternatives at this point?
So in a balanced portfolio right now, we have about 15% allocation to alternatives.
15%, you, Lars?
Yes, the bracket goes from 10 to 20%, and we roughly have between 15 and 20% for the time being.
And you as well?
Basically the same.
And what kind of investors, what type is looking at alternatives at this point, Norman?
I mean, we see increasingly a lot of people looking into the alternative space, not only for, if you like, substitute for volatility in equities, but increasingly because of the increased volatility we've seen in the fixed income markets, people are looking to hedge fund strategies or alternative strategies as a shelter for that.
I can understand because, you know, for an investor, it is absolutely important to diversify. But for a bank as well, Schwyzer Kantonalbank, looking at alternatives, is that a good bet at this point?
I mean, not only at this point. I think this should be, as I mentioned, a portion in your portfolio all the times. And we even don't time alternatives. So we have a more or less fixed bracket between 10 and 20%, depending on the risk profile of the portfolio. So in a balanced portfolio, we're currently holding roughly 15%. And it's not a thing of a point in time, but it's something you should hold in your portfolio all the times.
Do you agree with this, Lars, as well? Kind of a long-term strategy when it comes to alternatives?
Yes, and I would go even further. Instead of increasing risk, in fact, you are decreasing risk by having alternatives in your portfolio. And the key reason for that is they're less correlated than the other asset classes you have in your portfolio. Therefore, in a portfolio context, you're in fact reducing risk. You're not increasing it.
What about ETFs in that case? Would you reduce your exposure to ETFs at this point?
Oh, we definitely would reduce our exposure to, we'll call it not so much ETFs, but passive vehicles.
All of you reducing positions on ETFs?
Not reducing, actually. We just basically, in the developed markets, very efficient markets, we still hold ETFs because it's hard to beat the market with an active manager or with active stock selection. So half of the portion usually, typically in developed markets, is in ETFs and the rest is in single stocks or in active managers.
Interesting opinions there, not always the same. Let us play a little prediction game before we go. And I want to know where in Switzerland you would put your cash into which sectors right now. And please answer with a yes or no. We start with Norman, Thomas, and then Lars. So first of all, banks, yes or no?
No.
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 Clear no there. What about pharma?
Yes.
Yes.
As an addition to a portfolio, yes.
Good. Some condition there, but generally a positive answer. What about real estate in Switzerland? Is it a lucrative sector, Norman?
No.
Thomas?
Somewhat, yes.
50-50?
Wouldn't say that, be that clear on a no, because the yield still is very attractive versus bonds in Switzerland. So probably more yes.
And you, Lars, your advice?
Underweight.
Underweight? Okay, good. What about consumer goods, Norman?
We would be neutral on consumer goods.
Agree on that.
Yes. And you, Lars?
If it's consumer cyclicals, I'd go overweight. If it's consumer staples, I'd be neutral underweight.
You're very picky there. Good. What about the technology sector?
Technology, we would be neutral. I think its best times have passed. I think there are other opportunities.
And you, Thomas?
Probably neutral to underweight going into the year, maybe add later on.
For you, Lars?
I think very selectively. It very much depends on the specific stocks, their business model, and the regulatory risk. Therefore, I wouldn't put all my eggs in the same basket and just invest in technology stocks.
We
It's
always
case by
need to
case.
do our due diligence process, of course. What about telecoms?
Underweight.
Underweight.
Neutral.
All right, interesting. What makes you feel neutral?
It has been a sector which has been out of favor for a very, very long time. It has some defensive characteristics. Therefore, in a portfolio context, it can be attractive. And especially, and that's what tilts me to that opinion, they offer dividend yields which are very attractive.
I also want to talk about utilities. Yes or no?
No.
No.
No, underweight.
Hands off of utilities. What about basic materials?
Yes.
Neutral to slightly overweight.
Unfortunately, same here.
All right, we always need the basic materials. The last sector would be industrials.
Yes.
Not going into the beginning of the year, but later on, yes.
Definitely overweight.